Investors Chronicle.
Hello, one and all. It's the Investors Chronicle Companies and Markets show, recording this week on Thursday, the 6th of June. We've got our usual mix of company results and other goings-on from the investment world for you today. And we will begin with the flashing lights and clattering pins of Hollywood Bowl. The FTSE 250 business reported half-year results earlier this week, and Jennifer Johnson is on hand to discuss whether the nation's apparent love affair with bowling can continue. And Julian Hoffman will share his thoughts too. Then we move up the cap scale to talk about National Grid, which, rather than simply keeping all of our lights on, has rather more ambitious aims these days. That's involved some pain for shareholders in the form of the rights issue announced last month. Alex Hamer is here to examine that decision, as well as the company's medium and long-term prospects. And we'll finish by looking at one of the erstwhile more popular UK fund managers, that's Nick Train of Lindsell Train, who's issued another apology for recent poor performance. Dave Baxter will look at the nature of his current portfolio, how it's changed of late, and whether there is a light here too at the end of this particular tunnel. Hollywood Bowl, though, we're going to start with some leisure activities. Jen, as I say, the interim results were out earlier this week. Everything's still looking pretty good as far as the company is concerned, and investors too.
Yeah, absolutely. It's really kind of a wholesome story, a wholesome stock. Hollywood Bowl posted a record revenue figure in the first half of its financial year. Pre-tax profits were up 10%, thanks in part to some ongoing cost efficiency drives. They've upped their interim dividend. There are a lot of signs, essentially, that this is a business in good health and that people really still rate bowling as a leisure activity. It wasn't kind of a one-off after lockdown and people were simply excited to go out. People appear to be excited to go out and bowl.
A lot of things the company's done right over the past few years. One of them, though, the most obvious one in these relatively straitened times, one of them would seem to be, to me, the fact that they have not really raised prices, and bowling is therefore really positioned as an affordable family event that people can do and can still afford, and, as I say, it hasn't increased in price. Is that a core part of their strategy, and can that continue, really?
Yeah, by all indications, management is definitely fixated on keeping costs low. In the first half, it increased prices by just over 1%, actually, but that's well below inflation. It's really focused on maintaining affordability. It's about ensuring that people think of this as a good value day out. And that's especially true in the summer months, obviously, when various outdoor leisure activities might tempt customers away. The chief executive has this thing that he likes to say, which is that bowling has a gross margin of 100%. And that's true in the sense that sort of rolling a ball along a shiny lane doesn't cost the company anything. The company actually claims, though, that 72% of its sales are not subject to cost of goods inflation. So really, Hollywood Bowl doesn't have to put prices up in the way that companies in other sectors do. That said, maybe, perhaps, it'll choose to do so once economic conditions are better and consumers are less likely to notice that a game of bowling costs them 70p more or whatever the figure ends up being. But it's clear for now that management's focused on this value for money proposition. Another thing to note is that individual bowling centres set their prices, so they could theoretically rise in some regions and not others. But the important thing is that Hollywood Bowl is able to compete on extras, i.e. food and drink. And that's not just competing with other kind of local bowling centres. It's also competing with, the cinema and various other activities like that.
Yeah, we should say those are fairly big parts of the revenue streams, aren't they? I think food and drink is a quarter, and amusements, which is, the arcade games and all those things. Pool tables and air hockey and whatever they have in these places nowadays are another quarter. So that is a pretty big proportion of their sales. It's interesting, I suppose, to consider to what extent any price rises are baked into future forecasts. I have seen some analysts saying that the lack of price rises gives them scope to raise prices in future. But of course, then you start worrying about, whether this equilibrium is going to be disrupted and whether people are going to be affected by that. But what your point about regional pricing is probably quite useful in that regard, where they can tailor it to certain regions. Come back to the 100% margin point, because there are obviously costs the company does have, some of which is worked through. Energy costs have been a big issue for all operators, all kinds of businesses, of course, in recent years. Those are now falling, and in many cases they were hedged quite well anyway, I think, at the bowling companies. The other costs, though, are refurb of existing bowling centres, outlets, things like that, because there is wear and tear. There is maintenance cost there, but also in Hollywood Bowl's case, they have been kitting out these bowling lanes in a slightly different way in a bid to boost marginal revenues there. Can we say a bit about what these refurbs actually involve? Because they do like to talk about the extra pounds and pence they're making from those.
Yeah, I think one of the things to keep in mind with these refurbs is that they really are inevitable unless the feeling that you're going for is kind of vintage charm, then a tired bowling alley is not a particularly appealing prospect. So these refurbs involve upgrading sort of bar and dining facilities, replacing carpets, adding new lighting, creating space for amusements, that kind of stuff. So basically it's upgrading the amusements, ensuring that that's sort of on trend and that those are games that people are wanting to play, and also just making sure that aesthetically the bowling alleys look clean, appealing. And the extra profit from refurbishment tends to come from higher spending per game per customer, as well as extra spending on activities like arcade games. In any other industry, constant refurbs look like a bit of a red flag, but I think in Hollywood Bowl's case, it does give them a competitive advantage over companies that aren't, or individual bowling alleys even, that aren't upgrading this regularly.
Some of the things they do as well, don't they? VIP bowling lanes. Phil Oakley, our colleague, was talking about the other month, which is an obvious way to upgrade some revenue. I don't know what a VIP bowling lane actually constitutes, but clearly it will cost more. And the company targets an average return of 33% on each refurbishment, which is clearly a pretty good return if you can get it. But clearly there's a limit to how many times you can make that return per centre. That said, when they have so many different outlets, the refurbs can continue for a while, and of course they are also trying to expand the number of outlets they have around the country. What about competition? We talk about that because 10 Entertainment, listed peer that was doing pretty well as well, has been bought by private equity. There is the sense that there is a bit more competition. People see bowling as a popular activity, and they want to get in on that. To me, to some extent, now 10 Entertainment has been bought by PE. That might be a tailwind for Hollywood Bowl, because quite often in those cases the investment stops and the centres get a bit more tired, and that might actually push people towards Hollywood Bowl, give them more opportunity. Well, how do we sort of see that competitive risk for them in future?
Yeah, I guess one of the questions is, when is the UK in particular going to reach peak bowling? That's an unknown, remains an unknown.
Surprisingly under-discussed question.
Clearly not yet. We've not reached peak bowling. Hollywood Bowl, it should be said also, is the biggest operator in the UK. It's got around 71 locations. 10 Entertainment's got around 50, and then Regency Leisure has about 18. You've also got, obviously, independent local operators. There are signs, obviously, as you mentioned, Dan, that the market's becoming more competitive. You're getting new centres opening up in, former retail locations and on the outskirts of cities where there's adequate commercial real estate. But the key thing for Hollywood Bowl in maintaining its edge is keeping the price of food and drink low and ensuring that their centres are, the best that they can be. Really, it's also got 11 centres in Canada where it's hoping to expand further. That's obviously a large market with its own established operators and its own competitive landscape. But that also gives Hollywood Bowl an edge over groups that are entirely based in the UK.
The point about Canada is interesting. I was reading some things recently about Bowlero, the big US bowling company, which has been annoying customers by putting prices up what they say is unsustainable levels. So clearly this holding prices down strategy is very much a UK-focused one. Julian, I want to bring you in because I think you have some thoughts about Hollywood Bowl as well. What's your sense on the company and the stock as an investment prospect?
Yes, I mean, just to pick up on the VIP point, I once went bowling in Argentina on a bowling alley that was built exclusively for General Perón, but I don't know if Hollywood Bowl is going to go down that road.
Wow.
The interesting thing about the company, I find, is that it is actually becoming a very reliable dividend share from an investor's perspective. So the yield, despite the fact that the shares have run up nicely over the last couple of years, the yield is still about 4.4%. And it's indicative, I think, that they do manage to generate that quality of earnings to support that dividend. And importantly as well, they've eschewed buybacks traditionally. So their capital is, as Jen pointed out, is going straight into the estate rather than coming back to shareholders that way. But in going into the estate, it's also securing the revenue base to support the dividend. So there's a kind of virtuous circle in what they're doing, which I think is quite interesting. And they do have such a large competitive. I mean, I take the point about private equity, but in a lot of places, for a family that wants to go out for an evening, the bowling centre is the last place in town that you can do something for less than £50, say, for 4 people, and still have a decent evening of it. Whereas, if you go out to a restaurant or the cinema, even now, you're going to part the company with the best part of 100. And I think that's a very clever strategy that they've brought in about keeping prices low and affordable. And it's really about a footfall business now, that rather than an expansion business by location. I think that's also another important point, that they're looking to keep the customers coming through the doors rather than risking more capital on adding more and more places that have to be refurbished 2 or 3 times a year. And let's face it, there's nothing worse than a tatty bowling alley.
Well, opinions may differ on that, who knows? But I think it's a very, very good point about the way the company is generating its earnings and being able to pay those increasing dividends as well. The cash flow story is pretty strong. I think that is really underpinning the dividend case. Why don't we turn to the valuation, just to wrap up on Hollywood Bowl. Jen, how do you see the company? The share price have done pretty well. There's still, as Julian says, that good dividend yield there. What do you see the valuation case as at the moment?
So, FactSet Broker Consensus puts Hollywood Bowl's full-year price-to-earnings multiple at around 15 times, which constitutes fairly good value for a cash-generative leisure stock. I think so long as, again, as Julian mentioned, that you keep getting customers through the door. And also the company does have some kind of expansion ambitions as well. The chief executive said recently that it's hoping to expand to more than 130 centres from around 80 today. And that's across the next 10 years. So it's not, the most, it's not the most demanding opening schedule, but provided that goes ahead and provided people still like to bowl, it should do fine. And the dividend, they have increased the interim dividend. The dividend is significantly higher than it was pre-pandemic. So though the company might prioritise investment over share buybacks in the coming years, that shouldn't come as a surprise to investors, and the dividend should be protected.
As with all UK companies, it seems at the moment, but given the interest in the sector in general, it could be a target itself, of course, in future, as long as that bowling tailwind continues. One thing I have seen that, as part of the refurb, that would annoy me as a bowler is apparently in some cases the pins are being replaced by those pins on strings, if you've seen those, which some people are quite annoyed about because you don't get the big clatter of pins as you bowl a ball, which would seem to me to be the whole point of bowling. So that would be my investment advice. Stay away from pins on strings. But there we are. For now, it's all systems go. You can now get 12 weeks of an Investor's Chronicle print and digital subscription for just £12. You'll get instant access to our website and our app, plus the magazine delivered to your door every week. Check the terms and conditions in the show notes for more information. Let's turn to National Grid, our second segment, because there's been a lot of news flow there, Alex, in the past couple of weeks. They've had results. There's this rights issue, which is ongoing. Let's talk about the rights issue to begin with. They're also ex-dividend today on Thursday, the 6th of June, as I say. So a lot going on with the share price in particular. The rights issue, a necessary move, remove some uncertainty that won't really help investors who've already in the stock who have to wear this dilution. But what's your take on it?
Yeah. I mean, I was keen to dive in and talk about my favourite bowling alley, Rowan's in Finsbury Park. But
Well,
Second.
maybe
Yeah.
next time.
yeah.
I think National Grid surprised the market and a lot of its own bankers who it didn't turn to for this raise. When it announced this, it was gross £7 billion raise to fund its current regulatory period, which runs until 2028. So it's £7 million, 6.8 net, and that'll go into a £60 billion capital program, which they've announced. It's a really big move. I think we haven't seen a raise this big in a long time on the market, and it's not a surprise that National Grid needed a bit of extra cash to pay for this infrastructure across the electricity distribution and transmission networks, and in the US as well on similar things. What investors are facing is a lower dividend, a choice to maintain their holding. It's a 7 for 24 issue for shareholders, or if they don't take that up, they will effectively sell on that right to take on those new shares for a little bit of money. I think it's exciting, to be honest. It shows activity in the market. It shows a shift a bit more towards growth without just piling on more debt. We've obviously seen a lot of scrutiny over utilities debt levels, and National Grid is quite different from the water companies. But with this money, it's also going to clear a little bit of nearer term debt as well. So I think it's a really positive move.
Let's talk about, I think the deadline for rights issue, the rights issue will trade until next week, I think the 12th of June. And I think the deadline for take-up is, at the time of recording tomorrow, but at the time of publication today. So, limited time there. People will have probably made their decisions already. But let's talk about what this money is being used for specifically as well. As you say, UK distribution, transmission, but also we shouldn't forget, as you pointed out, the US business in New York and New England as well. How's it splitting this? Not just the 7 million rights issue, but the 60 billion 5-year capex plan that it's outlined at the results.
I think the context here has been laid out in the past 2 or 3 years as National Grid has talked about the increasing need for electricity capacity, and the reason they're doing that is because they think demand for electricity will grow significantly in the coming years. And the scale of this growth, National Grid's talked about the super grid developments of the 50s that gave us the networks we have today in the UK. So this is a substantial movement, and more specifically, we're talking about things like increasing connectivity between places where a lot of power is generated, so maybe offshore Scotland on the wind farms, and connecting that better with the north of England in the multiple industrial hubs there. I think if you talk to business, a lot of frustration has come from the really delayed process, or the process in which there are a lot of delays in connecting your big new piece of infrastructure or big new factory to the grid, and that's been really gummed up because there's such a worry about this that if I have, say, I'm building an electric vehicle or a battery plant, aka British Volt, I put my hand up and say I need this many gigawatts for 2028, and you have a solid spot in the queue, no matter the viability of your project. And that means compared to even current capacity in the grid, the waiting list for these new connections is 5 or 6 times that current capacity. So there's huge issues with that at the moment. And National Grid, in a plan that came out in recent months, has called for this to be completely rewritten, so that really high quality projects get access to the grid faster. And aside from that administrative issue, there is a greater need both across the transmission network and the distribution network, which is the distribution side of it is where it actually gets connected to houses and businesses, etc. We actually do need greater capacity there. At the moment, there's a set of projects called the ASTI projects. They come into the current regulatory period, which is the RIIO-3 period, which runs to 2028. There's work going on those. That's a few interconnectors, a few significant power lines coming from Scotland to the north of England, as I've mentioned, and so that's included in the 23 billion that's going into the transmission networks. All that is to say, that's a lot of slightly vague detail around power projects. Is that this is hopefully good for everyone, and having it on a more stable funding footing is really important, because the regulator hasn't actually said to National Grid, this is your regulated asset base and your funding base for the regulatory period in which we're now in. It started in April. So there was uncertainty over that period, and National Grid's basically said to investors, we've raised this money, this is cash that we can use immediately. Don't worry if we're going to be delayed on RIIO-3 any longer. We're doing this now.
Yeah. So that the regulated asset base is obviously the core part of National Grid. It is defined by regulators, as the name suggests. This RIIO-3, as it's called, we won't go into the initials because they're even more complicated if you get down into them. But effectively, they have had clarity on electricity distribution already, I believe, but it's the electricity transmission side which there is going to be more clarity on through this year. I think some detail from Ofgem is expected later this month. They're getting out ahead of that with this investment plan. It's probably likely to be approved because I think even the regulators recognise with something like National Grid that there is this need for more investment in the grid. They might even give them more leeway to make a bit more money on this investment. We'll see when that comes out in the following weeks and months. And there's also some positive signs on the US businesses as well. It seems they are also obviously regulated in various degrees, and there seems the US regulators have been giving a bit more flexibility at the regional level in New York and Massachusetts in terms of what they permit National Grid to do. And quite a bit of this 60 billion capex plan, almost half, is I think penciled in for New York and Massachusetts, New England there. So there's potential growth there as well. Why don't we talk about briefly, because it might not be much to say, the election impact. We are, of course, only 4 weeks away from the general election, probably going to have a new government. That said, because of all these things we just discussed, the need for more capacity on the grid, the transition to net zero, that kind of thing, it would seem to me at least unlikely that Labour is going to have National Grid in its crosshairs. Is that a fair assumption?
I think so, yeah. And this plan from National Grid, which talks about things like greater demand from heat pumps, people charging their electric cars, even things like, which is not net zero adjacent, but I think would be interesting to a Labor government, is greater demand from data centres, which all means greater investment, largely from the private sector. What Labor has in its plans currently is to create something called Great British Energy, which would roll up the Great British Nuclear, rolling that into it, but then also I think they've said they'll increase funding towards grid-esque projects by about 8 billion compared to what a potential continuation of the current government would put in. And I think the overall spending on the grid, there's pretty crazy numbers flying around. It's about 101 billion pounds against about 110 billion pounds under this Labor plan, and so it's not. Yeah, I think people have shied away from those kind of numbers because it's quite a long period. So I think a decade or so, and they're scary basically. But I think Labor's effectively trying to do the same thing, and the fact that National Grid's gone out, it's got private investment for this, which is partly the idea of Great British Energy as well, to provide cornerstone investment for projects that need a bit of help to get there, is a complete positive.
And from investors' point of view, the investment case for National Grid now, we've spoken for a while on various points about it becoming more of a growth stock than an income stock because of this need for investment. That's, I think, explicitly what the chief exec said at the time of the results last month when announcing the rights issue. Clearly, there's going to be some short-term volatility, not just ex-dividend today, but from the rump rights issue, and as that gets resolved in the next few days, a couple of weeks. But in the medium term, there's all this investment. It all sounds very positive, but I suppose the question for shareholders is, when is that going to produce a return? Is this an attractive entry point if you're looking at the company and you're not already involved? And should it be considered a stock that can produce good capital returns, or should it still be viewed? I think the dividend yield rebased is still going to be about 5%, so not unreasonable. Is it a buy and hold stock for growth, for income, for both? It seems to me it's still going to be quite a while before you see the fruits of these labours.
I think buy and hold is a good approach, even if there is volatility over the coming weeks. Yeah, I would probably be tempted to wait until it settles to come in. But they still want to. Well, they've said they'll put the dividend up by inflation annually. The dividend hit from this this capital raise is that they won't raise the actual level of the total payout. So you obviously get a smaller stake as an investor. The returns are interesting. I think they'll have to be careful on their debt levels. They want to keep it at about 60% geared under their industry framework. It might be a bit more with leases, but I think if they can do that and keep it, within CUI of 60-65%, they can hold on to that dividend increase. And then once you actually get usage of these newer projects, and this isn't planning stage, well, it is planning stage for a lot of these projects, but they're at work on the current Rio 3 projects right now. So this cash is going directly into the business on existing projects. So it will take some time for the really big changes to come through, but this will have an immediate growth impact, even if it's not massive.
Okay, time to move on. Nick Train, another apology, the latest apology, I think, as you wrote, Dave. I'm not sure how long it's been since the previous apology, but it is the case that his funds, the Lintel Train Fund and the Finsbury Growth Income Investment Trust, have underperformed for a while now. Let's start with what he said in his latest missive. What's he been speaking about in reference to performance and also the portfolio in general, Dave?
So we do have, another apology, as you mentioned. He says he kind of acknowledges it. And I suppose one point that's worth mentioning is the fact that he and the board of the Finsbury Growth and Income Trust have at least kind of stressed some sort of continuity, still like kind of conviction in the portfolio. So you're not necessarily seeing an overhaul of the process. But one thing that's interesting that he stressed is he's kind of acknowledging or claiming that he needs more exposure to what he calls technology advantaged companies and owners of big luxury and premium brands. And I would stress that you sometimes have to be a bit skeptical of claims like this from fund managers, but he's claiming that now 55% of that portfolio is in companies the team deems to have first-class data or tech assets. And he's saying that has come up from 30% in 2020. So I suppose if you are looking for some hope, for some silver linings, then perhaps you think now the portfolio is more built for the 21st century, as he's kind of put it as well.
In some cases, though, as you say, you do have to be careful with these descriptions because it is a case of rebadging, much as chief executives like to talk about AI now and tech. The people who hold various stocks would like to emphasize those aspects of them too. In fairness to Nick Trainey, has held a lot of these stocks for quite a long time. That said, I mean, he has underperformed for several years, as I mentioned, and this is relative to the UK market, not only the global market. So it's not down to a lack of tech in that regard. What are the reasons for that? What about, I think this year, the underperformance has been quite marked because he doesn't have any oil and gas commodities positions, which until a week or so ago were doing pretty well. But what about the years before that? Has it just been a poor mix of holdings?
Yeah, I mean, you can argue that, as with his global equity fund, as we've discussed in past years, like they've kind of missed the parts of the market that have outperformed, like tech or commodities. But as you mentioned, that's a bit different with the UK. So perhaps, given it's such a concentrated fund and stock-specific risk is so high, then maybe you can just argue that they've had a kind of handful of poor-performing names. You've mentioned to me before, like Unilever, Diageo, names like that. So perhaps it's just some of those big positions are kind of not faring particularly well on top of that kind of sector exposure or sector lack of exposure.
There's also been a change in the non-UK positions, which you are able to hold in UK equity portfolios. He's shifted away from them somewhat recently.
Yeah, so for various reasons, he has 3 non-UK positions in the trust. You've got Heineken, Mondelez, Rémy Cointreau. They did make up, I believe, 18% of the funds, and over a 12-month period, he has halved that exposure. In keeping with Nick Train's kind of general position in recent years, he's arguing that's because the opportunity in the UK is basically too great to ignore, so he's trying to sort of double down on that a bit more.
Yeah, the Heineken reminds me of the Diageo position, which is still there, and Diageo obviously has been pretty poor in the past year or so since its profit warning. I think last autumn it was. So clearly he's sticking with those positions too. Unilever, another turnaround story we've discussed many times on the show, which as a 10% position in the portfolio, or that's in the open-ended fund, I'm not sure what it is in the trust, you're relying quite a lot on that turnaround coming through. He has been buying other things, though. There are newer positions in there. Rightmove is one of them, which I think he recently said is building up to be a relatively sizable position, certainly, again, in the open-ended fund. Can we say a bit more about that?
Yeah, it's interesting. He, so late last year when he had kind of the, US market buying into one of the competitors of Rightmove, fund managers seemed quite split on that. They either sold out or jumped in. He's one of the ones that jumped in. He is trying to highlight that in those latest results as, what he calls tech-advantaged companies. And he's basically arguing that, it's quite hard to displace, and kind of in terms of its price, it looks quite attractive. And also, he's generally highlighted names that have kind of a decent stack of proprietary data, so therefore could be big beneficiaries of that kind of broad AI trend.
I think we discussed it at the time, but Rightmove, you have seen this competitive concern before with the likes of Zoopla and whatever that estate agent-backed company was, that both of which were going to steal Rightmove's lunch, and neither of those have really happened. So we'll see with the arrival of the US player. But it's a fair case, I think, that Rightmove is going to have the dominant position for a while longer. We should finish maybe by discussing the portfolio in general. What do you think about prospects for the future then, Dave? The big question. Is this relative underperformance? I mean, it's impossible to answer whether that will continue, but you look at the portfolio, there are a lot of big brand businesses in there. You do kind of know what you're going to get with Nick Train. Is it a question of case-by-case basis for individual investors, whether they back these businesses? It's not really. There aren't really too many hidden surprises in the portfolio, is one good thing you can say.
I think that's really useful because, you are assessing a handful of big names and then you can kind of make a call. And, like you say, there aren't really surprises. I mean, in theory, it looks still like a solid proposition if you think about the kind of big brands. And then, we talked about those names that could benefit from things like the kind of AI trend. You wonder if their approach continues to fall between the cracks, if we still see these kind of investment style rotations you've seen in recent years of something like cyclicals doing very well, and then the much more punchy growth stocks doing well. These are perhaps, you might class them as quality growth, a bit more boring, but hopefully it comes through. But like we say, you can monitor it quite easily.
You're right. If you don't have any of the the actual Magnificent Seven tech stocks, and at the same time you're not exposed to the miners. It looks logical, but sometimes you can, as you say, slip between the two and end up not performing as well as either. But on the face of it, there's potential there. We can say for now. Unfortunately, we have run out of time. So thank you very much, Dave. Thank you to Alex, to Jen, and to Julian, and to our producer, Vic Thornton. We will see you next time on another Companies and Markets show.